With the blessings of Ma Saraswati, written this book and launching with the blessings and good wishes from my family, friends, and followers, and inaugurated by all of you digitally free of cost on YouTube, Twitter, Facebook, etc. Author of the book Giriraj Lahoti, myself is an investor since 1980, shares his knowledge and experiences of the financial market and planning in this book, Golden Rules of Wealth Creation. I passed BCom from St. Xavier's College, Calcutta, and participated in course conducted by Calcutta Stock Exchange on stock capital markets in 1983. I completed export management from Institute of Export Management and running my family business of manufacturing and exports of jute goods. I completed a course on life insurance by IRDA and become an agent of LIC of India. I am an NSE certified investment analyst and portfolio manager. I am a NISM certified mutual fund distributor. I have been sharing my technical and fundamental analysis on stock and financial markets and planning with my friends, followers, and relatives, and also on different social media platforms like moneycontrol.com, YouTube, Twitter, Facebook, WhatsApp group Wealth Creator, and others. And my friends, followers, and relatives have been able to create great wealth from my analyzed undervalued scripts, to name a few like Cheviot, BSC, Birla Corp, L&T Infotech, Vedanta, Infosys, Sovereign Gold Bonds. I am thankful for all the testimonials and sharing some of them from friends and followers, and your appreciation gives me more inspiration to serve the investing community with my analysis freely and selfless way. Contents of this book is for educational purpose only. Contents are not any recommendation. I reserve the right to be wrong. Please consult your financial advisor before making any decision. Making money is a short-term process while creating wealth only happens in long term. Don't think you can make quick money in stocks and other assets. Don't go by tips and hearsay. It is a dangerous thing that people do. You have to understand what companies you are investing in and what is the aim of your investment is that, and then put your money in stocks and other assets. If you can't follow the path, then mutual fund route is better for all age group to create wealth. If you look at it over a period of time, large part of wealth is created through asset allocation rather than stock picking. If you are able to get right your asset allocation mix, then I think you have done 90% of your job. My suggestion to young people would be, if you are investing directly in equity, do your homework thoroughly, read research and annual reports, read about the company you want to invest in, gather more information about it, then make an informed decision. Will you be able to make money out of the market using trading tips? It never happens. Creation of wealth can only happen if an investor is looking at it as a serious business. Look at it this way: people will work for 8 to 10 hours in their job and make 8 to 10 lakh rupees a year. And the very same people want to make the same amount of money in a month's time purely acting on tips from their friends. From the efforts and return point of view, there is some disconnect, right? When you come to the stock market, you should come with a long term perspective, but they don't look at what kind of input they are putting in this effort. They should ask these questions: what kind of intellectual effort I am putting in this? What kind of research am I doing? Most investors don't do this. In my opinion, this is a very dangerous sign. What wealth creator investors should do: percentage of savings to be invested in different asset classes, LIC and health insurance, 7 7% LIC, 3% health insurance. Fixed deposit in banks 10%, tax free bond NSC PPF 10%, commodities like gold, silver 10%, preferably sovereign gold bonds, equity and mutual fund 35 to 40%, direct investment in equities through stock markets, through mutual fund, through an advice of CFA or SEBI registered financial advisor. Real estate 10 to 15%, investment in real estate through REIT is a new good option. Investment in real estate as a reward for regular rental income added with capital appreciation of the property. Cash 10%. Earlier theory of equity investment was 100 year of age was the percentage figure to be invested in equity, but recently these theories was debunked by Bernstein's report, so it is not necessary to have less exposure to equity in higher age group. That is 100 minus your age. Actual investment in equities is 45%. Out of this, 20% is through less risky equity investment plans, which will also provide us with benefit of long-term capital gains, tax for further investment in real estate for buying land and property. An investor can take his investment decision investing through mutual fund in a systematic investment plan, SIP in equities which has a good track record of performing, or he can himself directly invest in equities through a SIP, that is every month he can invest a sum of amount in blue chip stock or Nifty Bees. Now investor apart from investing in Indian equities can invest in international equity stocks also in exchanges. Investment in bank fixed deposit FD is accruing 7 to 7.5% of annual returns for non-senior citizen, depending on the bank's tenure and guidelines, which makes it widely sought after and safe investment alternative. The minimum tenure of FD is 15 days and maximum tenure is 5 years and above. Senior citizens are entitled for exclusive rate of interest on fixed deposit basis points 50 basis with additional 50 basis points around 7.5% to 8%. Tax savings FD under 80C each for a minimum of 5 years. Investment in NSC National Savings Certificate is subsidized and supported by Government of India. It is a secured investment technique with a lock-in tenure of 6 years. The investor is entitled for the calculated interest of around 7.5%, which is given 2 times in a year. National Savings Certificate falls under Section 80C of IT Act, and the profit accrued by the investor stands valid for tax deduction up to 1,50,000. Investment in public provident fund PPF like NSC PPF is also supported by the Indian government. An investment of up to maximum of 1,50,000 is required to be deposited in a fiscal year. The prospective investor can create PPF account in a GPO or head post office or in any subdivision of the nationalized bank. PPF also falls under Section 80C of IT Act, so investors could gain income tax deduction of up to rupees 1,50,000. The rate of interest of PPF is evaluated yearly with a lock-in tenure of maximum 15 years. The basic rate of interest in PPF is around 7.5%. Investment in mutual funds. Mutual fund firm accumulate cash flow from willing investors and invest in share market like stock market. Mutual fund investments are also entitled for various market risks, but with a fair share of profits. One should select mutual fund schemes based on all or some of the following criteria: long-term and short-term performance, consistency in returns, performance during bullish and bearish phases, fund managers' performance with the fund's operation. Investors may invest in lump sum and in SIP both ways as per their goals. He may invest in total equity and debt, hybrid funds, balanced funds, multi-cap funds. A simple way to select a mutual fund scheme to invest is to select a 5-star or 4-star rated fund from one of the following rating agencies like ICRA Rating, Value Research Online, Money Control. Investor can take advice of SEBI registered mutual fund distributor, financial advisor and experts. In ELSS scheme for 3 years can give 80C benefit and capital appreciation. Now investor can invest in international equity fund along with large, mid cap, small cap, multi cap and thematic funds. Investment in gold, silver. Investor may invest in sovereign gold bonds of Government of India through their bank, net banking in units of 1 gram of gold and multiple thereof up to maximum 4 kgs lying in demat form in their DP for a period of 8 years with exit option after 5th year to be exercised on interest payment dates with prior request. Benefits: freedom from hassle-free storing of physical gold, additional interest of 2.5% per annum paid half yearly on initial investment, apart from capital appreciation, exempt from capital gains tax on redemption, can be used as a collateral for loans and can be tradable on exchanges. In physical gold at the time of selling, khad, cut, problem, price difference are there, but in a sovereign gold bond it's not. Who can invest? Resident individual, HUF, trusts, universities and charitable trusts. Apart from SGB, a little percentage may also be invested in physical silver till its bonds, silver sovereign bonds comes. Cost of purchase. Cost of purchase is of prime importance while purchasing any stock. First thing is market capitalization of that particular stock at the time of purchase, as your cost of purchase depends upon the market capitalization of that particular stock at that time. And net profit percentage, return on market capitalization of that particular stock, is an important tool of judging how much net profit percentage return that particular stock is giving on its market capitalization. If net profit percentage return on market capitalization of that particular stock is 15 to 20%, then purchasing that stock will be considered as an excellent investment. And if net profit percentage return on market capitalization of that particular stock is 10%, then purchasing that stock is very good investment. And if net profit percentage return on market capitalization of that particular stock is in the range of 5 to 10%, then purchasing that stock is considered as a good investment. But if net profit percentage return on market capitalization of that particular stock is below 5%, then purchasing that stock is considered as an average investment. It is always advisable to compare net profit percentage return on market capitalization of a particular stock from its peers, and which has greater net profit percentage return on market capitalization, that particular stock should be preferred, with other criteria fulfilling discussed in our screener tests. Ideally, net profit percentage return on market capitalization should be more than FD returns of 7 to 7.5%. Invest in the industry which you understand better. While investing any particular stock, we should know about that industry in which that company does its business, how that industry is running at present, what are its future growth prospects, how that particular company is positioned among its peers in that industry. If it is possible to invest in the industry which you understand better, or if you are a businessman wants to invest in equity, and if you are performing well in your business, means that industry is doing well. And as you know this industry business well, you can invest in that industry well. Moreover, suppose in your business you are achieving a turnover of rupees 2 crore by whole time involvement of your finance, labor, time, etc., and as an investor by financing only rupees 20 lakh by buying shares of the company of your same business, and you become partner of that company's turnover to the extent of 2 crore and partner to the net profit to that extent. In this way your turnover becomes 4 crore and net profit is sometimes more in where you are investor by financing in buying of the shares of the company of your same business, then the net profit you earn by your own company's business by whole time involvement of finance labor time. Start your investment with your peer group. Once you start investing directly in the stock market, you should start investing in the business, buying a stock which you understand better. Suppose you are a steel trader, then you will understand Tata Steel, JSW Steel better than other businesses. And you should treat this investment in this company as you are also have the share of sale one alone done by the Tata Steel. I am giving my example as I am a jute products manufacturer, so I understand jute mill business well. So I started my investment in Ludlow, Cheviot, Gloucester as they are my peer group by the simple philosophy as I am doing well in my jute manufacturing business. So by investing my surplus savings fund in my peer group Ludlow, Cheviot, Gloucester, which are also doing well, become owner of the sales to the extent of my investment in it, and it has rewarded me always handsomely as investment in this company never shakes my confidence by the volatility of the market. When you assume bullishness in jute products market, you can purchase the share of company and hold it in demat form. You don't have to purchase the physical stock for paying go down rent, selling the stuff, then realizing the profits. And my experience has always been I have got more return in investing in the shares of jute company rather than buying and selling of physical stocks of jute products. Management integrity is of prime importance. When you plan to invest in a company stock, first of all you have to watch management's integrity, corporate governance. If company's payout ratio is good and company is following good corporate governance, then investors should think and decide on investing in that company. One example in which I got a good return betting on this integrity of the management, a company's chairman in its AGM as told to its shareholders as it has started paying dividend after a long time, it will continue to give dividends. After 3 years, company gone into loss, but management kept its promise and given dividend to shareholders from general reserve, and this news moved me and I got confident on the integrity of the management and invested in that stock, and it given me six-fold return in a 2.5 years time. Screener test for selection of buying a stock for investment. First and foremost, good corporate governance, integrity of the management, payout ratio of management to reward the shareholders by regularly paying dividends, special dividends, bonus, buybacks, etc. How much of the net profit generated is distributed? The maximum the percentage, the better. Consistency of growth, generating profits and dividends. Bonus, reward the shareholders, to reward the shareholders, good corporate governance. Second, net profit percentage return on market capitalization. It should minimum be at least double the amount of FD, fixed deposit. At present FD rate is 7 to 7.5%. So net profit percentage return on market capitalization at the time of investing in a stock should minimum be 12 to 15%. The more the merrier. Number 3, consistency of making profits and dividends payout, good dividend yield, consistency of making profit for last 10 years and paying the dividends for last 10 years. Dividend yield should be minimum be at par with savings bank interest rate, that is 3.5 to 4%, and if it is 5% to 7%, that is equal to FD, then better, and if it is more than FD return, then it is the best. Promoters' skin in the game. Promoters holding in the company should minimum be 60 to 70%, and if it is 70 to 75%, then it's the best. Point 5, debt free cash rich company. It should be debt free cash rich company which does not pay interest, rather earns other income from being cash rich company till organic or inorganic growth prospects are not there. 6th point, no pledge of promoters holding. Companies promoters should not have pledged their holdings. Point number 7, available at par or below the book value. It should not be above book value, at par with book value, or half the book value. The more the discount to book value, the more margin of safety. Point number 8, low equity base. It should have low equity base of 5 to 10 crores. In low equity base, floating stock is low, and any good news propels price discovery mechanism northwards in a big way. Point number 9, leader of the sector. It should be one of the leader of the sector. As being leader of the sector, having good market share, good brand value in the sector, any good news, any good cycle for the sector, commodity reward the leader the most. Point number 10, under-owned and undiscovered. If the stock or script is passing all the above 9 screeners and it's under-owned and undiscovered, then chances of good wealth creation is very bright. Point number 11, stocks should be remaining above 200 DMA maximum time. Point number 12, reading annual reports, brokerage report. Investors should read annual report of the company and brokerage report of the company and sector. If it's positive, then invest. Point number 13, investors should think like a promoter or partner of the business while buying the stock, and remains with the stock with different business cycles, as we don't close our own business when at low environment of the business. Likewise, when we remain invested in the stock for long term, as with our own business, we will be able to create great wealth. In some cases, I have seen people doing own business in the same sector, invested in peer group, made more money in investments of the stock of the peer groups than in their own business. Point number 14, courage is the essential essence of investing to create wealth. Apart from the above screener test, passing by the stock or the company, investor need to have most important thing, courage, without which you cannot bet big to create great wealth, as it is not important how much time you were right, but how much big you make when you are right is most important thing. Education, intelligence, contacts, information, like you are a CA, CFA, research analyst, etc., will help you a lot. But if investor don't have courage, he will not be able to make a great wealth. Point number 15, invest your savings only. Investor should invest his savings only. Never invest in a company more than 15% of your investable capital, may increase with the time. Point number 16, never ever leverage. Investors should not leverage to make an investment. He should invest his savings, which he can forget for a long term, which creates wealth for him. Point number 17, investors should be able to assess his risk, appetite and risk and stress management, and never invest at the cost of your peace, as peace is the most precious and invaluable thing of life. Investors should enjoy investing. Peace is precious, time is precious. Peace is the precious thing of life, and no work should be done which takes it away. When we invest our savings in equity, not to buy sleepless nights but to get better returns than fixed deposits of 7% risk free, and equity having 12 to 15% CAGR return. So to get 5 to 7% extra return, investor should take that much of risk which is reasonable and easily achievable. But when he starts to gamble, asking big returns in a short time and starts buying sleepless nights, big wealth is always created by investors who have given their investments a reasonable time, as Rome was not built in a day, because business which you bought will give reasonable return in a long term. I have seen a small amount of investments by investors in companies like Infosys, MRF, iShare, Page, Colgate, Nestle, and many more created great wealth for them. No to future and options. Future and options are the weapons of mass destruction in financial market. Even full-time options future traders find it hard to earn from this. No to day trading. Equity stock market is made and it's a place for investing or buying businesses, and not business. Equity investment gives return in long term. Day traders buys a business, buying a trade, and closes the business after half an hour, selling the trade. Can any business make money in this way? In this way, day traders trades with the price which is relevant to commodity market fluctuations, whereas equity stock markets is a place for value creation which businesses gives in a long term. Wealth creation through investment for long term. Equity stock market is a place made for investment or long term, avoiding day trading, avoiding future options. And by avoiding future options and day trading, you find enough time to run your business profession, which has got certainty to earn and then save and again invest, whereas day trader future options has no certainty to earn, and moreover your precious time you save and invest in your business profession to grow. Secondly, when you invest, you become a sleeping partner of that business, earning same as the promoter, but promoter has to give full time as an active partner for growth of the business. I have seen investor creating great wealth than so many big corporate houses. They have enough time for other works. So a long term investor have enough precious time for his or her business profession and other activities of life, and they are full of peace, so they create wealth and enjoy their life. A long term investor can do this by direct investment in equity market or investment in mutual fund on a regular basis. Rome was not built in a day. To reap the rewards, to create wealth as we start business, it takes time to prosper, and when we buy a stock, we are buying that business which will take time to reward, but we start to value it by its price fluctuations, which is traders valuations, maybe day traders, swing traders, or hourly traders, or minutes traders. But for investors who have bought that stock for its value and not the price, and the price should not be the cause of concern for investors. Earlier days we used to get the rates of the stock in the next day's newspaper, but today we get the prices of our stock at a click of second on mobile TV channels. So we should follow the advice of Oracle of Ohama, Sir Warren Buffett. We should buy such stock thinking if markets are closed for some time, we should not have any problem. Even now, that patience is very much required if any investor wants to create wealth. As Sir Warren Buffett, maximum of wealth creation happens after he crossed 55 years of age. Likewise, for Sir Radhakishan ji Damani or Sri Rakesh ji Jhunjhunwala, they remains invested in their stocks like Coca-Cola and India shaving product Gillette, Titan, VST respectively for a long period of time. So patience, which is a rarest of rare thing found in present time, as our brain has become habituated of everything getting in a click of seconds. We have to develop this rare quality if we want to create wealth. How to develop patience? Point number one, be a calm and cool and peaceful. Don't react immediately, understand. Speak less. Try to learn and hear others' opinion. Humble and humility. Silence for some time in a day, week. Abstinence from mobile. Yoga, do yoga. We should always be satisfied for the result of our work, because when we are contented, then only we are peaceful, and when we are peaceful, we will be able to have patience and the correct decisions. Day trade, live trade, future and option trade. History data and stalwarts tells wealth has been created through investment and not by day trade or future and option. 90% of the day traders generally lose, and the 10% remaining smartest of the smarter barely meet the return of FD. This data is shared by Giroda, the top brokerage houses of India. Then why to waste our precious time when return is equal to FD, when we are smartest of the smart? Regarding future option, is made for hedging for big mutual fund, hedge funds and HNI, that too for a little time, not always, but investor in greed of big quantity trade leverage through future options and find difficult to make wealth from here either. Masses loses their purse daily, and some smartest of the smart lose his chest vault in a day. Warren Buffett once said, future and options are the weapons of mass destruction in the financial market. Even if whose main profession, that is full-time stock market invested trader, for them what I have followed I am sharing as a investor come trader come jobber. Point number one, keep your ego and emotions out of the trade when you day trade. Kill emotions, then day trade. Because everyone who comes to market is intelligent enough, only upper hand taken by the trader who is egoless and emotionless while trading. Point number two, self control and discipline is of paramount importance in day trade. Where I am always buyer at lower levels and seller at higher levels, essentially profit by jobbing by trading in a very small quantity of 4-5 trades maximum in a day with a pre-decided risk reward ratio of 1:2, and in a losing situation take delivery of the stock for the day, so never loss. I don't put stop loss and average in loss. Point number 3, concentration and focus, cut noise. Point number 4, trade on your known stock only. Avoid impulsive trade, don't trade outside your watch list stock. Point number 5, no excitement. Excitement is an emotion, and in a day trade it kills your trade. Point number 6, do your homework before starting the markets. Point number 7, wait for opportunities, not for timing. Point number 8, trade only in the stock which has liquidity, depth and momentum. Point number 9, Always trade in a small quantity so that you are not uncomfortable. Point number 10, quality is important, not quantity. Take maximum 4 to 5 trades in a day. Point number 11, pre-decide risk reward target ratio 1 is to 2. Point number 12, any day is not independent. Please follow that stock previous day support price action. Point number 13, when you expect profit comes in your day, shut your screen and close your trade for the day. Point number 14, in the morning if you start losing, don't try to cover the loss very same day. Take delivery of the stock and make it an investment so not lose for the day. Point number 15, I am of the view and practice day trade, swing trade in the stock where I am already invested, where I am already buyer at lower levels and seller at higher levels, earning profit by jobbing, by trading in a very small quantity of 4-5 trades maximum in a day with a pre-decided risk reward ratio of 1 is to 2, and in losing situation take delivery of the stock for the day so never loss. I don't put stop loss and average in loss. Point number 16, as I don't put stop loss and average in loss, both are not allowed in day trade but allowed in investment. It's benefiting me as I day trade as an investor come trader come jobber. Point number 17, as try to cover every strategies and points to be covered while executing possibly a foolproof profit making trade, but as for every individual trader the strategy giving them positive result should be followed, as there is no sacrosanct rule in the stock market. Strategies working for me may not be working for others. Please follow your strategy which is profitable to you. Emotions plays a vital role in creating wealth for an individual investor. If you cannot control your emotions, you cannot control your money. Emotional quotient of an individual investor plays a bigger role than intelligence quotient of an individual investor. If you don't control your emotions, it will affect your actions in making right decisions. Once we make a trade, investments on viewing certain fundamentals, technical analysis on a stock or a commodity, and the price action of that particular stock or commodity is not catching as per our expectations, at that time many investors traders become impatient and starts losing confidence. This is the time where our controlling and managing the emotions plays a vital role, to understand that every trade investments requires time to reward, so patience is needed. So investors should develop this emotion if he wants to be a successful investor. Two more emotions plays a vital role in investment in any asset class: fear and greed. If you manage and control the emotions of fear and greed well, you are always one step ahead of others. An investor should be greedy when masses are fearful, and fearful when masses are greedy, because market never obliges the consensus. It is very hard to manage the emotions of greed and fear when market is erasing everywhere. Everyone is pessimistic on the street and pointing the canvas of investment horizon with bleak future. Markets are capitulating, masses are selling, analysts are suggesting not to catch falling knife. You will find it very hard to take a buying investing decision in such a fearful environment. Your emotions control and management plays a vital role. With calmness, that investors who are selling are in panic and prices are capitulating, so you will not get better bargain of the same, and if you becomes greedy, then you have managed your these emotions well, which will reward you handsomely, which you will find it at a future date. Likewise, in exuberance, investors scramble to buy stocks at frothy valuation, as then there is no tomorrow. Everywhere everyone is talking about a particular asset class, equity market, commodity or real estate. Everyone is giving tips, message starts closing their businesses, diverting their business money to stock markets. Everywhere is euphoria of stock market or a commodity or real estate. You should be cautious and fearful. I remember in 2008, one of my friend called me up and asked me how many applications I am making for Reliance Power. I was astonished to hear from him something related to stock market, as we were in a friendship of 25 years and he has never talked about stock market, and he was telling he was applying for every members of his family for Reliance Power. I was about to apply, but the emotion of fear stopped me, as I started to think, who will buy my shares, as the last person remained outside of the stock market is applying. So buyers, investors, euphoria is at peak and market is at a saturation point, and my emotion of fear played a vital role, and I did not apply for Reliance Power, and moreover I sold my portfolio, which proved to me right decision, as market fallen like 9 pins after that. At the same time, one of my follower, to whom I have advised like many to invest in real estate through equity in 1992, as I foresee a big spurt coming in real estate. So at that time in real estate only one stock was listed, that was Unitech, and the investment made of 30,000 on my continuous advice to hold on by him in 2008 becomes 12 crore, and I advised him to sell that, as at that price it was according to me fully priced, or to some extent frothy valuations due to euphoria in real estate stocks. My emotions of fear played a vital role in advising him to sell that stock, and rest is history. You will continue to suffer if you have an emotional reaction to everything is said to you. True power is restraint. If words control you, that means everyone else can control you. Breathe and allow things to pass. Sometimes managing emotions of ego plays an important role in investment decisions. While going through fundamental technical studies, we form an opinion about markets or investment, but that opinion is rejected by the market. At that time, our managing our emotions of ego plays a vital role to rethink on our opinion, revisit our dashboard to recheck our decision, rather than being adamant on our opinion or decision, because market is supreme. Sometimes only one thing only we miss, which market have seen, which changes the story. So we should leave our ego at home when we enter the market. And most important of all above emotions is being humble and having humility. These two emotions keep your arrogance apart, and you are able to accept, learn, hear everything what market says. Your humbleness and humility brings good wishes, blessings, which is the most invaluable wealth one man creates, and his humbleness and humility makes him understand what by God's grace he is getting. He is thankful to the Almighty, and his contentment for that which brings him peace, which is the most precious wealth. Winning experience in one of the highest ever market fall in market capitalization terms of Indian stock market along with global markets. in 2020 January March period during corona outbreak. January 20 to March 20. Point number 1, selling, booking profits in invested stock as market was finding difficulties moving higher with broader participation of the market. Some scripts were moving higher to lift the index, but broader market not participating, hence declines were outnumbering advances, indicating of distribution. February 20, when market started falling and breaking 200 DMA, kept the fund in banks as sometimes patience is required to postpone the purchases. March 2020, when corona fever gripped the market and it shattered, fell around 33% from top, which I follow to buy, whereas individual scripts has fallen 40 to 50% or more to buy back of 25% of the quantity which I have sold in January 2020. While I have a view of market going down, so on capitulations buying the stocks help, as in such times volatility index rises abnormally, so in that time you have to play one side as an investor, buying the capitulations and riding the pullbacks, and booking profits rewarded me. It worked better as if you sell blank assuming to buy at lower levels. In such volatile times, your opinion about market may be right, market may go down, but in such volatility you are chopped out if you play both ways, that is playing bear as well as a bull. Point number 5, so it is better to play as a bull by buying the capitulation. Trading strategies should be riding the bull pullbacks and booking daily profits. No carryover of bullish positions in bear market. Wait for the capitulations and then entry to ride the pullback and get out of the same day. In such volatile times, every nimble-footed approach should be adopted. No aggressive trade positions, either bullish or bearish, should be avoided. Main focus should be protection of capital, and secondary options should be earning profit and preserving it. Point number 8, in such once in a while event in a century, investors should be very cautious while taking any investment decisions and always follow staggered approach of buying small quantities in SIP on every capitulation. Point number 9, avoid of making bearish and bullish trade both at same time. In such volatile markets, I opted to make bullish trade only at the time of capitulation, and riding the pullback rewarded me. As investment, as investors, it suits the masses. It may trigger your stop losses in both trades, and market again becomes in your side, but your trades in both sides become loss making, and after some time both the trades are profit making. So market says the participants to be in either of the side. The current situation is not very promising, as we can see a continuous rise in COVID cases, and it is difficult to say it is the bottom, it is here or not. Once the pandemic issues resolves, economic activities can be seen gaining momentum, basically due to increased consumption, and therefore a judicious investment can be made for next 5 years. The ratio act as one of the indicator. The ratio act as one of the indicator to channelize investors to remain invested at current levels, but one may note that these indicators do not assess in the short term timing of the market, and investors should not jump and buy solely on the fact that the ratio is so attractive, suggest expert. The other reason which makes experts believe that the bottom could be some time away is the fact that we have fallen just 38% in last 3 months, which history suggests that bottom formation has taken anywhere between 10 to 27%, and it takes around 15 to 20 months, whereas less than 3 months in the ongoing fall. The market cap to GDP ratio today is around 0.53, which matches that of December 2008, while the Nifty in the current bear market has fallen 39.57% to its low in 2008. It had fallen as much as 61%. Some scripts has fallen more than 60 to 70% from the top, so by that percent might those script have made or near to its bottom, so which are available below its intrinsic value, also book value, well below replacement cost, having generating cash flow, having no debt, and average adverse from the current cycle environment instead. Where is the bottom? It is time to buy the fear, but in a staggered way, because the bottom could still be some time away. India's market capitalization to GDP ratio has declined from 79% as on FY19 to 54% FY20 GDP ratio, much below its long-term average of 75% and close to the levels last seen during FY 2005 and FY 2009. Makes it attractive. The Nifty is trading at a 12 months forward ROE of 15%, above its long-term averages 14 to 14.5%. According to Warren Buffett, market cap to GDP ratio is the best single tool measure of where valuation stands at any given moment. In one of this article back in 2001 with Fortune magazine, trend in India market cap to GDP percentage trading below its long term period averages. The ratio acts as a good barometer when it comes to studying market valuation, but experts differ that we have made a bottom, although we might be trading at level last seen during the 2008 financial crisis. The ratio is at its lowest level since FY 2006. In such unexpected times, it is hard to find bottom of the market, but darkest hour of the night is the indication of the beginning of the dawn. Be fearful when others are greedy, be greedy when others are fearful. When everyone believes something is risky, their unwillingness to buy usually reduces its price for the point where it is not risky at all. Consensus negative opinion makes it the least risky thing, since all optimism has been driven out of its price. So we might be very close to the start of the dawn, and once this remedy of the virus is got or contained, companies with strong balance sheet will do better. What should investor do? The current volatility is a reminder of the real nature of equities: unpredictable, risky, hard to forecast, and prone to throwing surprises, especially in the short run. This is also the few time tested rules investors should follow. Invest only, point number 1, invest only risk capital in equities, that is the portion of wealth that can be spared for 3 to 5 years or longer and on which volatility Volatility can be tolerated both emotionally and financially. Point number two, never borrow and invest. Avoid future options except of hedging. Point number three, maintain diversified portfolio of direct stocks or mutual funds. It would also be advisable to invest in 2-3 phases over the next few weeks or months. As Sir John Templeton says, it is impossible to produce superior performance unless you do something different from the majority. We are we are in a unprecedented times. Faith versus fear. Faith and fear cannot coexist. Where faith exists, fear cannot. Of course, faith is not easy to find, and even once found, it will be tested several times. Faith is the time tested, it is validated. Faith is not for faint hearted. The problem with some of us is that we have faith in our doubts and doubts in our faith. However, things can be turned around recently. Most of us have been reading and viewing on media about the virus, and often fake news create fear and it grows, and we start believing in the worst stories. We must have faith in humanity and medical science that in past such pandemics has happened and we were able to come out of that victorious. World is not going to end. Someone rightly said corona will pass, so will the opportunities. Currently world is grappling with this question: how long corona spread can get, how long the lockdown will last, and what will be its impact. How will the business and economies get impacted? May have degrowth for some time or quarters. We may not witness a sharp recovery. Companies with good balance sheets, cash reserves, and cash rich companies with flexible cost structures will smoothly sail through this time, but companies with high leverage and debt with high fixed cost will have tough time and they will be risky for investment. One is enough for wealth creation. राह पकड़ तू एक चला चल पा जाएगा मधुशाला. Every investor should have one stock in his portfolio which makes the fortune of that investors, like Coca-Cola did for Sir Warren Buffett, Titan for late Sri Rakesh Jhunjhunwala ji, and India's saving product for Bhai Sahab Sri Radhakishan Dawani ji. When they can, all of us investor can choose one stock which according to you have a high level of integrity in management, a great fundamental debt free company regularly making profit and year on year growth in profits, 60 to 70% promoters holding, no pledge of shares by promoters, leader in their segment, fundamentally in a sector which has good presence and future, low equity, good dividend yield stock, good payout ratio, available below book value, cash rich, under owned and undervalued and undiscovered. And my first criteria is net profit percentage return on market capitalization, which should always be better than FD return. Otherwise, why should invest in riskier assets? And above all, never invest in a stock at the cost of your peace, because it is precious. Invest time not to watch the daily rates of that stock, rather devote time to learn more and more about that company and that industry and its future prospects where you invested. I am sure all of us investors in 10 to 15 years time will be able to have made fortunes from that one script, and masses will give our example also for holding that one particular script for long term and creating wealth. राह पकड़ तू एक चला चल पा जाएगा मधुशाला. Investors better positioned than promoters. Investors investing in a particular company, acting as a buying that business, becomes sleeping partner of that company, but the promoter looks after day to day affairs of the company. Promoters is the working partner of the company. He invests his full time and money for the company. It's look like investors has employed promoters to look after daily affairs of the company, but in regard to payout, the investor who is a sleeping partner gets the same amount of dividend, same amount of bonus and same amount of capital appreciation of the stock price which the promoters get. Only extra thing, promoter is given salary for his 24-hour service towards the company, but the investor is free from investing his time for that company. Rather, he can invest his precious time in running his own business and other activities. So when you invest in other companies, you earn everything same as promoter, and whereas where you are promoter of your own business, that profit also you are getting. So investors are always better positioned than promoters. IPO as wealth creators. One thing I would like to share with all of you, which I have observed when I was 16 years old. I used to apply for new issues IPO, and I got at that time good quantity of today's blue chip like Hero Honda, Glaxo, Grasim, EP Tata Sponge Iron etc. at face value, but due to lack of knowledge and advice, and as that time share market participation in family, friends and acquaintances was not seen in a good eyes. So with my small savings, when above shares I was getting, I used to sell making a small profit, which if kept it till now would have created great wealth, and that is still on, as we see in latest IPO like DMart, HDFC, MC, IRCTC. It's a human psychology that a small quantity in IPO which you get doesn't bother you to hold for a long time, or even forget to enable you to create great wealth when you hold your fundamentally good stocks for period of time. One example on my advice, my neighbor applied in IPO of Infosys investing 9,500 and kept it for a longer period of time to fetch him 4 crore. There are many such examples. So think over this, and I hope and I wish every one of us are able to create more and more wealth in times to come by investing in fundamentally good IPO for a longer period of time. Timing your exit most important. Market needs Arjuna, not Abhimanyu. Share equity market is like a Chakravyuha of Mahabharata, where we all enter like Abhimanyu but doesn't know how to exit like Arjuna. So we have to be Arjuna for to know how to exit, which is the most important thing in this market, either in booking profit or cutting losses, trading or investment. Exit with strict stop loss should always be in place to protect your capital and to maximize the return. Keep always a trailing stop loss so as to get maximum return and protection of profit. Timing exit from a stock is important, and constant review is necessary if you want to get the biggest bang for your buck. Here are few fillers that can help you time your exit. When target achieved, book your profit. I have seen in my 40 years of stock investing experiences many a times an investors whose targets met, but out of greed they do not book profit, repents miserably in future. Two of the instances I remember now, and I want to share with the investing public so they learn from the mistakes of these investors. In 1989, one of my friend's daughter was born, and he asked me idea to invest her 30,000 got on his birth gift from family to invest in equity for a target of her marriage to be handed over to her. And at that time I liked real estate as a grossly undervalued asset class, and at that time Unitech was an only real estate stock listed in Indian bourses, and I had a target of 18 to 20 years, and Unitech was regularly dividend paying company also. So according to my analysis, I recommended for Unitech where she will get dividends regularly and capital appreciation. As I expected, after 15 to 20 years in 2005, this investment became 50 lakh. Her father, my friend, asked me what to do. I told him, if if it has started moving up as market has now finding value in this sector, wait for the time till this sector finds exuberance, and as our target is her daughter's marriage, and he constantly asked me what will be its price. I told him it will be 5 crore. He used to tell me you are mad. When that happened again, he asked me what will be its price. I told him 10 crore. That also happened. People known to him given me calls for, in their words, buying such vision in a stock was important, but most important, timing, constantly advising to hold the stock for seeing such magnificent value unlocking. In 2007, when her marriage was happening, which was the target, I told him to book the profit. The profit, do you know what was valuation of that 30,000 investment at that time? It was 12 crore. I told him to book the profit as I was viewing exuberance at its height in that sector and Unitech, and coincidentally our target for her marriage also come. So I told her to book the profit of 12 crore profit. If the present price we see, it is Unitech is now valued only 4 lakh. If he would not have booked the profit, now it is only 4 lakh. Caution on new highs. While you cherish seeing your stock touch new highs every day, remember it is also time to raise your guard with the list of stocks that are at new highs. Increasingly, with each passing day, chances are that some of your stocks too may have scored well, though each new high may tempt you to stay put in hope of more gains. Take the final call based on valuation and future growth potential only if you are convinced that the stock can go higher from where it is now. Stick to it, otherwise exit while party is still on. Point number 3, missing an opportunity. The exit from a stock is important for two reasons. First, to ensure that you are not caught unawares when the stock price tumbles. Point number 2, you don't miss a better peak. So when the stock has met its price objective and its future performance does not seem as promising, you should look out for newer stocks to invest in. Remember, there isn't much place for laxity in an investor's life. Stocks are dynamic, and therefore constantly reviewing is necessary if you want to get the biggest bang for your buck. Sometimes when your stock gives a phenomenal return in a very short span of time, you can say in 2-3 months time 200%, 300% return. At that time, one school of thought tells sell the quantity of shares which returns you your capital, and your remaining holding in that becomes free of cost to ride the future profits, and if the prices fail, you have no problem. Or if the price fell 21% from its top, or from the all the time top, its price fell and closes below its previous day's low, a trading stop loss should be placed as per your purchase price, and review of the situation should be done at the then prevailing market rate. One technical indicator may be followed. Sometimes if a particular stock is up from its 200 DMA 110 to 120% or more, then it may give a call to review the position and if needed to exit for the time being. What investors should learn from his mistake, which most investors do, they become more greedy, whereas we should be fearful, and when others masses are greedy, and we should be greedy when other masses are fearful. When our target has come, we should book profit. Even if we want to re-enter, we can re-enter, but once our target is met, we should book profit at that time. Above incidence was fall out of greed, and next incidence is of attachments. At the time in 1989, another friend of my advice, on my advice, invested 15,000 in Unitech, and that became 6 crore in 2007. And on my advice, he sold the shares, but his grandfather refused to taking food after that, as he created wealth in a MNC company like Colgate, so like Unitech, so he became so attached to it, so under compulsion for his wish, they have to buy back those sold shares, and they are worth only 1 lakh now. So what investors should learn from this investor's mistake: never get attached to a script. Treat it as a investment, not as your loved one, which most investors put in considerable efforts to choose to stock they think will be multi-baggers, if may not reap as much benefit if exits aren't timed equally well. It is therefore important to know when to convert the stock back to cash. After all, paper profits are well just paper. There are a few more fillers that can help you time your exit. Periodic review. Use the opportunity to do a thorough reading of the financials of the companies you have put your money in. See how the numbers look when compared with earlier years and against its peers. Do not be too happy to see company post bumper growth and profit numbers. Give allowance for low base of last year into your financial working. Look beyond numbers and see if companies would be able to do better or at least sustain their growth momentum in the next fiscal. Value. Alongside the financial performance and company prospectus, keep tabs on the valuation metrics of your stock. See how they stand against market valuation, Sensex or Nifty price earning multiples, and against its peers. While stock with PE multiples at a discount to the market at peers may be worth remaining invested in, the final decision cannot be taken in isolation. Compare the valuation with the company business fundamentals and further growth potential. If growth potential does not justify the valuation, it may be time to exit your investment. Mission accomplished. An investment truly pays not when it soars in value after you invested in it, but when you take money off it. Remember to book profit periodically. While it is best to let your profits expand, if market volatility gives you sleepless nights, you can consider booking partial profits on your investments. What wealth creators investors should avoid. Retail investor generally does a great mistake by converting their non-profitable or loss-making trading decisions into an investment decision. Suppose a retail investor buys shares for a day trading on a tip of impulsive buy to earn by day trading, but that decision becomes a loss-making trade. Then the retail investor takes delivery of the stock and converts the trading bet as an investment bet, and that small loss becoming bigger and sometimes irrecoverable. This is the mistake maximum traders come investors do. Always treat your trading and investment bets separately. Day trading bets should always be done with a stop loss basis following technical rules. For a retail investor, day trading and future trading should be avoided as day trades and future trades needs high degree of professionalism, knowledge of technical analysis, skills of trading, and strict discipline which a trader should follow. When a retail investor wants to trade, he should think there is a 50-50% probability of profit or loss. When he makes trading bet, supposing when a trader bets considering a possibility of loss of 2000 in his trading bet, he should invest that 2000 only in any of the blue chip companies thinking he has lost in a trading bet, and whenever he has desired to day trade he should repeat this practice. After 10 years he will be able to create compulsorily more wealth in the form of equity investment in blue chip stocks than what he would have done by day trading in the stock for these 10 years. Do not ever gamble in commodities. It is always better to invest in gold, silver yearly, which will create a wealth in 50-20 years. Through gold bonds, sovereign gold bonds, it is best. Always avoid gambling and betting of any kind. These habits destroy wealth. Don't ever borrow to invest. Financial doctor, financial advisor. For our health, legal or mechanical matters, we always consult the concerned person who has taken expertise in the concerned subject by doing a degree course of 4 to 5 years of MBBS, LLB, engineering respectively, with an added expertise of many years. But for our financial matter, we do not consult a financial doctor or financial advisor who have successfully completed a certificate diploma courses conducted by financial institutions, NSC, BSc like equity research analyst, investment analyst, portfolio manager, mutual fund, wealth management, financial planner, financial advisor, and have expertise of several years in financial markets and investment. Rather, we try to manage our finances and portfolio ourselves and do not take expert advice of a financial doctor, financial advisor who can always give better result by their advice. By this, our responsibility is being taken care of by him, and we are able to invest our quality time enjoying our life, which is invaluable. Financial doctor, financial advisor gives us remedies, solutions for all of our financial matters. When to invest, where to invest, how much to invest in different asset classes, and most important part, how much and when to exit, because entry everyone takes like Abhimanyu, but we should know how to exit like Arjuna. Point number 2, reshuffling, reviewing the existing portfolio of different asset classes time to time, reshuffling, reviewing the specific equity stocks, its entry, exit, hold decision. Point number 3, analyzing the market news and act as a active hedge fund manager to reap the maximum gains and profit, protecting the profit. Point number 4, investing and managing buying businesses, equity asset classes for long-term wealth creation. Point number 5, LIC, Mediclaim, PPF, mutual fund, equity savings and other asset classes managing. When we seek advices from doctor, we have to disclose all details to get the proper diagnosis and medication from him. Likewise, if we disclose all the details of our finances and portfolio to the financial doctor and financial advisor, we will be able to get the best of proper advice from our financial doctor, financial advisor. God bless the investor community for wealth creation. Till now, I have discussed fundamental and psychological analysis of an investor. Now I am discussing technical analysis, that is of gain percentage theory, Dow theory, Fibonacci theory in a gist. The most important technique tool is probably the percentage retracement gain divided the price action into 8 parts. Each part was divided by 8 to get a unique percentage. Gann believed that this percentage can be used to identify the tops and bottoms posted by script. The average percentage that can got by dividing the price action into 8 parts is given in table 2. As indicated in the table below, the three most important percentage are 37.5%, 50% and 62.5%. These percentages can be calculated from either a bottom or top or for the previous move following the formation of a significant top or bottom. Thus, if one finds that the script has retraced by 50% from the top and represents say 62.5% retracement of the earlier rise, one should become alert as the possibility of the reaction having ended becomes quite high. Gann was a firm believer in the 50% retracement rule. As per this rule, the script should find support at the 50% retracement level. This level is calculated by taking the net rise. For example, if your script has moved up from say 10 to say 40, the net advance 30. In this case, the 50% of this would be 15. Hence, as per the 50% retracement rule, it is likely to find support at around 25, 40 minus 15. Now, should there be a top or bottom in the vicinity of 25, that level gets added importance. Again, in some of his literature, Gann has stressed the 50% retracement from the top as another likely support level for scripts. In our hypothetical example, the top is at 40 and 50% retracement would bring the prices to low of 20. This is the table. Gann has stressed the 50% retracement from the top as another likely support level for scripts. In our hypothetical example, the top is at 40 and a 50% retracement should bring the price to a low of 20. Capital management. Gann laid greater emphasis on capital management. He suggested that one should divide the capital into 10 equal parts and never ever commit more than 1/10 of the capital in any single trade. Gann emphasized the need for maintaining stop loss levels. This would ensure that the loss, if any, will be limited to the desired level and would not wipe out the entire capital. Changing your mind. In share trading, the most important aspect is that of placing the stop loss order as and when a trade is initiated. More often than not, traders who were wise enough to place the stop loss order cancel the same when they see that the market is going against them. At times, they even shift the stop loss level to try and give them for the market to move in the desired direction. This is very serious and may result in greater losses. 9 times out of 10, the trader will be richer if he maintains the original stop loss level and refrains from cancelling it. Do not cancel the trade initiated or change your mind without adequate reason for the same. Be firm in your thinking. Over trading. History is replete with examples of traders who have lost due to over trading. This is the one evil that one should guard against by following the rule of capital management and stop losses very strictly. Protect your profits. In share trading, apart from capital protection, profit protection is equally important. Never let a profit run into loss of capital should the market reverse direction. This can be done by simply raising the stop loss level progressively. Suppose you have initiated a trade at say 50 and your stop loss is placed at 45. Then as and when the stock moves up to 55, raise your stop loss level to 50. In this way, the capital will stay intact even if the script were to reverse direction. Also, as the profit increases, increase the stop loss level progressively to protect the profits made. This system of progressively increasing the stop loss level will ensure that you roll your profits and cut your losses. Like this, progressively the stop loss from the top level below 10% on closing basis should be levied. When to buy? Double or triple bottom. One may buy a double or triple bottom with a stop loss placed 1 to 3 points below the double or triple bottom. When to sell? This stock commodity market is like the Chakravyuha of Mahabharata, where people know how to enter like Abhimanyu, but very few people know how to exit like Arjuna. So you have to become the Arjuna of this stock commodity market. Purchasing a stock for long-term profits should not be a decision that is easily arrived at. As shown, there are a number of key fundamentals that need to be checked out before you can feel confident that you are looking at a potential big winner. You need to know enough about your stock so that you will feel confident enough to ride them to big profits. Once your homework is done and you have bought a stock, you have now taken the responsibility for your new investment, and after all your dollars are now at risk. Rather, rupees are now at risk. If things work out as planned, your stock will have a long and profitable journey. However, the best laid plans of even the finest stock investors often go astray. Therefore, from the outset, you must plan to monitor every stock you buy from purchase until it is sold, hopefully many years later at a substantial gain. Monitoring a stock does not mean calling your broker 3 times a day for quotes, nor should you be concerned with each day's closing price. What monitoring your stock means is to keep on top of the key fundamental development which could, should they turn for the worse, change the status of your holding from a buy to a sell. Most small growth stocks will eventually lose their steam and need to be sold. For the truly successful companies, this may take years. Those that grow to the status of the Fortune 500 are the real exceptions to the rule. However, your growth stock don't need to reach that level to make you a lot of money. If they do so, much the better. When you purchase small company growth stocks, you must find yourself susceptible to the emotions of fear and greed. To counteract these oftentimes ruins emotions, you will need to develop a rational approach to selling your stocks. Fundamental analysis will be most important factor in determining when to sell a stock. Technical analysis should be used to augment the fundamental decision making process. Of course, it would be great if all your stocks turned out to be winners. Unfortunately, however, it is also important to know how to handle a losing position. Double or triple tops. One may sell at double or triple tops with a stop loss placed at about 3 points above the double or triple tops. Fibonacci retracement. The Fibonacci retracement levels are 23.6%, 38.2%, 61.8%, 78.6%. While not officially a Fibonacci ratio 50% is also used. The indicator is useful because it can be drawn between any two significant points such as a high and low. The indicator will then create level between those 2 points. The percentage levels provided are areas where the price could take support or reverse. The golden ratio is 61.8%. Fibonacci retracement can be used to place entry orders, determine stop loss levels, or set price targets. For example, a trader may see a stock moving higher. After a move up, it retraces to the 61.8%, then it starts to go up again. Since the bounce occurred at a Fibonacci level during an uptrend, the trader decides to buy. The trader might set up a stop loss at the 61.8% level, as a return below that level could indicate that the rally has failed. Fibonacci levels arise in other ways within technical analysis. For example, they are prevalent in Gartley patterns and Elliott wave theory. After a significant price movement up or down, these forms of technical analysis find that reverse trend to occur close to certain Fibonacci levels. Fibonacci retracement levels are static. Unlike moving averages, the static character that of price levels allow for quick and easy identification that helps traders and investors to anticipate and react prudently when price levels are tested. These levels are inflections, inflections points where some type of price action is expected, either a reversal or a break. Days moving average DMA. There are three types of moving averages: short term moving averages, medium term moving averages, long term moving averages. Short term moving averages are 10 to 20 days, 30 days, 50 days moving averages. Medium term moving averages are 100 days and 150 days moving averages. Long term moving averages are 200 days moving averages. Generally, a short term trader takes views from short term averages for trading script indices for bullish or bearish trade 10, 20 or 30, 50 DMA. An investor generally looks for long term averages when a script remains above 200 DMA, can be considered for long term investment. When 50 DMA is higher than 200 DMA is called golden cross and considered a good price action for the stock or indices, and when 200 DMA is lower than 50 DMA it is called death cross, which is not considered a good sign for the script and indices. Conclusion: if investor follows the contents of this book, I am quite hopeful he may be able to create good amount of wealth, as well as he will be able to manage it. The 5 pillars of wealth which I suggest to adopt, which will help to create and manage wealth, are wealth protection. This is the first and most important pillar of wealth. Without adequate protection, you will be vulnerable to the nasty effects of a chance misfortune, which will cause you to suffer unnecessarily and possibly tremendous financial losses. Wealth maintenance. This second pillar of wealth analysis, your general financial health such as cash flow and debt position. A net positive cash flow with no overcommitted liabilities is considered healthy. Wealth accumulation. The third pillar of wealth drives you towards meeting your long-term financial objectives. Fourth, wealth enhancement. The fourth pillar of wealth maximizes the growth potential of your assets. Fifth, wealth distribution. The fifth and final pillar of wealth looks at preserving and distributing your estate. The only certainty in life is that it will not last forever. Testimonials from Raju Bhandari, Bombay, having 1 to 5% stake in several Indian listed companies. Transcript of Raju Bhandari reading. I have followed Girirajji's advice and recommendations. My personal judgment is there is 0% error in his judgment. He is any day better than branded equity advisors and fund managers. His analysis and predictions are better than the experts in business, but you are not in business of advising. You do it as a hobby and helping others. A magician will be suitable to describe you because your predictions are always true and accurate. Never you have made a mistake. St. Xavier's College alumni represented by Naresh Gupta reading his transcript. I met you at the hallowed portals of St. Xavier's College way back in 1980, and since then we have been friends. I have never met anyone else who is so humble, pious, caring, knowledgeable, analytical and studious. You managed your jute business since student days with impeccable sincerity, diligence, hard work and honesty. Now you are enlightening people about investment opportunities through Wealth Creator Group and Money Control app. Your recommendations are always of highest quality stock which give good return both in prices appreciation and dividends. In general, no one has lost money who invested on your suggestions, and you make it possible with lots of research and in-depth analysis. I pray God Almighty to bless you with long health life so that you can keep guiding masses with your knowledge and intelligence. Arihant Rampuria, PwC, PricewaterhouseCoopers. I had just started with investing in equities and then came across Giriraj uncle when I was looking for jute bag manufacturers. A brief interaction with him left me awestruck. Behind each of his recommendations lies passionate and deep studies. He is one of the few persons whom I can trust with full faith. Thanks a lot for sharing your knowledge and looking forward to gain more wisdom and understanding by being connected with you. Jashal Saha, Bangalore, reading his transcript. Giriraj Lahoti ji is a person who is passionate about value-based investing. His knowledge is quite strong and has an eye to catch hidden gems. His advice has made profits for me and so many people I know. He is an avid supporter of environment and you can see that in his pics as well. You are in trusted hands with him. Priyansh Agarwal, Delhi. I was very skeptical at first when I read his analysis. Then I started analyzing them, and in the very few days I was peculiarly struck with how his analysis was so accurate. I then started to follow his analysis and was greatly benefited with it. I told about his analysis to my friends who with I were equally happy after implementing his analysis in my portfolio. I am grateful that he gives his analysis to everyone for holistic benefit for everyone free of cost. Dr. Bikram Singh, Delhi. Giriraj sir is really a very admiring personality and is a true gentleman. I respect you a lot. Apart from your recommendations, sir, you have been a guiding soul for all of us and many other things which is very true nature of yours. Sir, God bless you with such worthiness. I am a very low personality to say something about you. You are really very nice by nature and values as you are helping fellow beings. It's great to know you, sir. Keep inspiring. Supreet Kumar, Bangalore, money control follower. Giriraj Lahoti sir is having a well-versed knowledge in stock market. Everyone knows that gems exist in oceans, but finding them is very difficult. But sir do it with ease. I am new to stock market. When I joined his WhatsApp group after seeing his recommendation and following him in on money control, I become a big fan for him. If someone asks me whom you will choose as a financial advisor, definitely I will say Giriraj Lahoti sir. Thank you.